In this video, we're going to talk about Chapter 13 bankruptcy, and while you're in the Chapter 13 bankruptcy, the ability to purchase a home with an FHA or a VA loan. So stay tuned for more. My name is 𝐬𝐮𝐬𝐫𝐞 with the 𝐬𝐮 Mortgage Team. What is a Chapter 13 bankruptcy? There's a Chapter 13 and then there's a Chapter 7 bankruptcy. A Chapter 7 bankruptcy is a bankruptcy where you file, and when you file, basically all of the debts are excluded. You are no longer liable for the debts, and that would be ideal. However, the waiting time to be able to purchase a home while you're on Chapter 7 bankruptcy is 2 years, okay, for an FHA or a VA loan, and it's even longer for a conventional loan. But in this video, we're going to focus strictly on Chapter 13 bankruptcies with a VA or an FHA loan. A Chapter 13 bankruptcy is where you have actually gone through the bankruptcy proceedings and they deem that you have to go with a Chapter 13, which has a payback plan on it. And it's not all that bad, you know. A payback plan means that every single month you're gonna have to pay until all of your creditors are completely paid off. And if you do not finish the bankruptcy, then you will be dismissed, which is not good. You don't ever want to be dismissed because you'll still have these delinquencies if you skip payments. On a Chapter 13 bankruptcy, a lot of people do call in every single day. They send us messages every single day saying, hey, I filed for bankruptcy. I don't think I can purchase a home. Or, hey, I've gone online and I've done some research, or I've been told by a loan officer or elsewhere that we can't do it. One of the most important things that I will have to say to you is that it can be done with a Chapter 13 bankruptcy after 12 months of making your payments on time and nothing else going late. But the important thing here is that you have rebuilt your credit after bankruptcy. Not only did you file the bankruptcy, whether it's Chapter 7 or Chapter 13, but you have rebuilt credit and reestablished credit right afterwards, okay? So what is reestablishing credit? Reestablishing credit is going back out there and getting secured credit cards or unsecured credit cards and making sure you're using it for something, right? Even if it's one tank of gas and then you pay it off every single month. It's really important that you reestablish that credit and have multiple trade lines. And some of the best tips that I can give you for reestablishing credit is to get that secured credit card, okay? The other way that you can reestablish credit is something that I've done in the past. Like when I first purchased my first home, I had my mother add me onto her credit card, you know, as a joint user. So as a joint user, there's a little more credibility in that because as a joint user, you're responsible for the credit card. You can't come off of the credit card. As an authorized user, it's a temporary thing. You're authorized to use the account right now. However, at any time, if me and you were to get in an argument or something like that, or I felt like, you know, I don't want to help you anymore, I could take you off. When you're rebuilding or reestablishing credit, you really have to be careful with the way that you do establish credit. And the other thing is that, you know, I would calculate my own debt to income ratio. It's very easy to do, okay? So you take all of your monthly debts, okay? That includes the bankruptcy monthly payment. You're gonna put your car loan in there. You're gonna put any student loans. You're gonna put anything that you have in here. And let's just say your monthly debts are $1,000 a month. Your income is $4,000 a month. So it's a 1 to 4, okay? So when we do that division, okay, debt to income, debt versus income, you're at 25% debt to income utilization. Just know that for most manual underwriting loans, such as you're in a bankruptcy, okay, we really want to keep that debt down, okay? We want to keep it down because when we're looking at your housing payment, we want to keep it between 31 and 40% on the front end, and that's just the housing payment versus your debt, or versus your income. And then we look at the back end debt to income ratio, which we really want to keep under 45%. We're looking at all of your combined debt, that includes those credit cards, the installment loans, everything added together, monthly payments only, and the housing payment, and we're dividing that by your monthly income. If that is, you know, $2,000 versus $500, or $5,000, like $2,000 in total debt versus $5,000 in income, now you're at a 40% debt to income ratio. So when you're doing those, when you're out there acquiring debt with the intention of wanting to purchase a house, this is 100% something that you really need to take into consideration. The VA and the FHA are going to be the only ones that are going to allow you to purchase a home during the Chapter 13 bankruptcy. And this is really good because we've had a lot of changes in the guidelines on conventional recently. And with those loan level pricing adjustments, we've probably seen it out there. Hey, you know, for affordability, the first-time home buyers, the lower income borrowers, they're going to have more of an ability to purchase at a lower interest rate on a conventional loan versus someone that has a higher credit score, like the 760 plus range, with a bigger down payment. You're going to have a higher interest rate. That's totally, like, I get it. It's good, but this is the FHA loan, and it's going to open up way more opportunities. Where I was recently looking at a chart and it had hot zones as to which loan, based on the down payment and the credit score, is going to give you the best outcome when it comes to the monthly payment. FHA really stands out right now. FHA provides great value when it comes to the interest rate. The mortgage insurance dropped by 30 basis points. And really, in this Chapter 13 bankruptcy, all you really need to do is ask for trustee permission. So once you have been approved by the lender, before you start going shopping and getting under contract, I would immediately file for a motion to talk to the trustee, get permission to be approved. And at that point, once we get that trustee permission, and we know that we're gonna stay within certain numbers, that's gonna cut out a significant portion of the underwriting time for you. If you're going through the process of getting trustee permission, I would say that's gonna take anywhere between 20 to 45 days to get that trustee permission. So we don't ever wanna be under contract so long that the seller is gonna get impatient and wanna move on to another buyer. After all the bankruptcy is completely off, one of the benefits of going with a VA or an FHA loan is that they do offer a interest rate reduction or a streamline refinance on both of these options. If you had to take a higher interest rate because of the manual underwrite, then we can always, after 9 months and 210 days or 9 payments and 210 days, you will then be eligible for a streamline or a cash out refinance. The benefit of the streamline or cash out is if it's cash out, then you can possibly take out some debt or additional debt to pay off existing debt. So I've talked about this in the past. Whenever you're doing a cash out refinance, you're able to stretch your debts out by 30 years in a fixed secured mortgage payment versus having a bunch of unsecured debts that are more like 5 years or, you know, even shorter terms or interest only terms where it takes you forever to pay it off. Or if you're just looking to lower the interest rate, we can look at the interest rate IRRRL, which is the interest rate reduction loan, or a streamline refinance, where now that you're totally out of the bankruptcy, all you're doing is redoing the loan, okay? There's no more income verification. There's no appraisal verification with the interest rate reduction or the streamlines. Whereas if you're doing a cash out, we are going to be verifying your income, assets, and liabilities and the value of the house all over again. What does this accomplish? And what benefits do the cash out accomplish for you? While you're in the Chapter 13 bankruptcy and you purchase the house, if at a certain point you do have significant equity, you can do a cash out refinance. And this is the benefit, okay? You're getting out of your bankruptcy discharge earlier with the cash out refinance. And some of the benefits of the early cash out refinance bankruptcy discharge is, I mean, the biggest thing is you're out of the bankruptcy, right? Now, when creditors are looking at you to extend credit, they see that, hey, this person really took the time out to pay off their bankruptcy early. And because of that, we're going to give them basically automated approval rates, okay, versus manual underwrite guideline rates. So it's really beneficial, and you know, we have a lot of customers that do take advantage of buying out their Chapter 13 bankruptcy early. In conclusion, some of the most important things to really notice in all of this is, okay, if you file for Chapter 13 bankruptcy, it's okay. Just make sure when you're applying for a loan, you're not late again. Make sure we have trustee permission all up front. You have your loan estimate or cost estimate worksheet. You have the pre-approval letter from the lender, and get approved by the trustee before you start shopping. And there's a lot of benefits even after you've been discharged from the bankruptcy. So if you have any questions or concerns, feel free to reach out to me and my team. My name is David Zyh with the Zyh Mortgage Team. I can be reached at 757-478-8493, and I'll talk to you guys later. I'm out.